exactly what's happening around the world because the numbers are kind of crazy. So here's the numbers, and you might have to watch this section a couple of times, so press the J button on your keyboard to go back 10 seconds if you need to, but it's going to get very, very nerdy. Now, here in the US, the 30-year Treasury bond is wanting to touch 5% interest, if it hasn't already. And it's happening even though the Fed is telling us that they're going to lower rates. Now, I want to remind you of something that happened to the US economy that we've been through, which marked that a recession was most likely going to happen. If you remember, for the last couple of years, the US yield curve became inverted, meaning if you ever wanted to borrow money, it was more expensive to borrow for the short term than the long term. And that's not supposed to happen. That's bad because normally, if you're buying a treasury bond, you would want more money for locking your money away for longer because you take more risk. So you're like, if I'm going to give you my money for 2 years, fine, pay me $100. But if I'm giving you my money for 10 years or 30 years, pay me more money, right? That's how it should be. So the line, or the curve as economists call it, slopes upward. That's when the economy is healthy, so that makes sense. Now, an inverted yield curve is when the opposite happens, and it usually signals a recession will happen in the future. In fact, here's a chart that shows what happens when the 10 and 2-year Treasury bonds become inverted. You can see a kind of countdown clock begins, and we get a recession at some point after the inversion. Now, in the year 2022, our curve inverted, and it went on to become the longest inversion of all time for about 2 years straight. Now, we have not yet declared this recession, but today, the curve is steepening again, which at first sounds good. Sounds like we're recovering, but we're not. That's because in a healthy looking line, the steepening happens because short-term rates fall as the Fed cuts, while long-term rates might drift a little higher, but they stay relatively stable. That's a good steepener. What we're seeing now is not that situation. The curve is becoming steeper because short-term rates are still high. It's still expensive to borrow money. Short-term rates are not really going down, even though the Fed is saying that they will. And long-term rates are rising even faster. That's what's called a bear steepener. It means we're basically saying we don't trust the government to control inflation